Hey guys, what's up? So our financial model template has become a pretty big reference for a lot of companies. So far, the free template has been downloaded over 10,000 times. A lot of that is because we've talked about it in our YouTube videos, a little bit because our people are starting to find it through Google and Google search. The point is our financial model template has become quite popular. If you're watching this, maybe it is because you've already downloaded it. But anyway, the idea for this video is to kind of go through the whole financial model itself to understand, all the settings, pretty much all the numbers that we've added in there and all the functions that the financial model can do for you. So this video is going to focus on our kind of general template. We're going to go through every single step of what a financial model usually has. We also have templates that are specific, that are kind of pre-built to a specific type of business. So for example, subscription business or an ad-based business or a marketplace. We've built templates for each one of those, and those are available for purchase on our website. So, we've made specific videos for each one of those templates, but this is the first one that you should watch before getting into the details of any of these other templates that I'm talking about. All right, so let's get started. We've built this template in Google Sheets, and that we felt was a more universal format, but if you need to download an offline version, you can do that, and we have an Excel version of it. All right, so on the homepage, all you're going to get is some promotional stuff. You can book a call with our team, so we have a team of experts available. If you need kind of specific questions or if you need some formulas built for you on the model, you can book a quick 30-minute call with them and they can help you out. Like I said, you can download this or make a copy to keep it on your own as Google Sheet or download it to keep it as Excel. And again, links to all the other templates and to all the other tutorials are also available on this homepage. All right, so the first thing that or kind of like the most basic thing that you want to understand on this template is our nomenclature for the color coding. Blue is going to be any input on the sheet. So anything that you are supposed to change or that you should change is going to be highlighted in blue. And any black number, those are going to be numbers that are based on formulas. So numbers that are the results of a calculation. Maybe it comes from the same sheet where you are or from a different sheet. But those are going to be black. So if you need to reference something else, you should do it in black. And if you need to input an assumption, something that you can change or that you should change, you should stick to blue. And then we're going to do a breakdown of all these sheets here. So there's a summary of what each one of these does. And that's what I'm going to be doing in this video. So let's go to settings first. OK, so in the settings section, you'll be able to change your company name. So let's keep that as Slidebean. The currency of your model. So this is going to be the model doesn't use a currency and formulas, so you can just change the symbol here. I don't know if you want to do euro. You can just change that. And then the model start date. So we're allowing you to start this model 2019, 2020, or 2021. And that's, for example, if you want to bring in some historical data. So if your business has been operating and you want to bring some numbers from 2019, you can set the model back to that year. Or if you're really not going to be doing anything in 2020, you can start the model in 2021. OK. Initial cash balance, that's going to let you add up any money that's been invested into the company already or any money that's in your bank accounts today. If you don't have any cash balance now, if you're still looking to raise money, then that number should remain at 0. Then we have taxes and inflation. So this is the income tax rate that's going to be based on your country. And then the inflation. So the reason why these numbers are important is because this model is going to let you estimate what your business valuation is. To estimate the valuation, we're using there are several ways to do that, but the model uses what we call discounted cash flow. So discounted cash flow is, in summary, a prediction of how much revenue your company is going to generate over the next few years. And then we're telling investors, well, this company is going to generate, or we predict that it's going to generate this much revenue. And because you're investing early on, we're going to give you a discount on that future cash flow for the company. In a nutshell, there's an article there from Investorpedia that kind of goes over the details, but this section here will let you estimate that valuation. So for example, there's a valuation box here in the financial statement annual. We'll get to this sheet in a second, but this is the net present value. So that is arguably a number that you can use to negotiate with investors as to what your business valuation is today, assuming that, of course, the projections that you've added are accurate. But there's a discount rate, again, for the discounted cash flow model. There's a multiplier for your EBITDA. So whatever number of profits your business is going to be making, you're estimating that your business could be acquired by a multiplier of that. For example, in SaaS companies are often acquired for 5 or 10 times their EBITDA. So that's a reference as to a potential exit for the business and therefore useful for this discounted cash flow valuation estimate. Then we have your debt capital ratio and your debt interest rate. Again, these are both related to this math, like the inputs required for this discounted cash flow math. All right, then for capital expenses, so the capital expenses CAPEX sheet is rarely used. We at Slidebean don't use it very much because it lets you estimate the capital, like the assets that your company has. So for example, in accounting, if you're buying computers or if you're buying, I don't know, a large server, who does that anyway, but whatever. So that's an expense. So it's taking away from your cash flow. But it's still an asset that the company owns. For tax purposes, that's not an expense as much as it is an asset that your company still has. It still has value. It's still in your books. And that asset is going to depreciate over time. So the CAPEX sheet is mostly focused on those assets. And then the depreciation for them is estimated here. So for example, you're saying that any stuff that you do to your office is going to have a 10-year depreciation time. Office furniture is going to be depreciated in 5 years, computers depreciated in 3 years, and so on and so forth. At the early stages, at least we didn't use this very much. It's there, like the model provides that functionality. Depending on your business, this stuff might be more important. So that's going to vary, but functionality is there. And then operating cash, this might be useful to other types of companies because it lets you estimate your accounts receivable. So for example, you could estimate that your business is going to charge customers, but they're not going to pay you right away. Maybe that's going to go into accounts receivable and you're going to be paid on a net 30 or net 60. So, your revenue is delayed a few months. And that's really important because you need to cover the cash flow for those months. So the CAPEX sheet lets you do that. I'm not going to go into that many details because most of these companies or most of the companies that are using our model don't really need to dig deep into this stuff. And if you need to dig deep into this stuff, you probably know your way around it, I hope. All right. So next up is teams and salaries. And this is one of my favorite sheets because we've come up with a nice system to let you estimate how your team's going to scale over time. So we've classified your team into operations, product, marketing and sales, and customer support. And these positions, notice that the numbers here are all blue. That means that you can go ahead and change those numbers and those names. CEO might be, I don't know, chairman or whatever. So use them as a guide, like keep the operations staff inside the operations section, the product staff inside the product section, and so on and so forth. Also, don't, try to keep this as simple as possible. We noticed that a few people were needing more than the 5 original positions that we were adding, like from CTO to junior developers, for example. People were coming up with new positions. That's fine, but try to keep it as simple as possible just so that you're not overwhelmed by the model. But yeah, you can add, say, I don't know, a mid-level designer or mid-level developer here and kind of estimate their salaries based on that. All right, so notice that the next column here is the expense category. So the model's going to let you do this. The model has this functionality that's going to let you estimate what your expenses are. So if you're building a pitch deck, one of the most common questions is like, where's your capital going? Where are you going to be spending it? So the model, by classifying people into these categories, that lets you kind of tell investors or estimate, well, how much of your round, how much of the money that you're raising is going to go into product development, into R&D, into marketing, or into operations. I think that those are the top 3 categories I would expect: operations, growth, and R&D. But you can do others if you want. So these are, this is a drop-down, but you can change them in if you want to go to data validation, and change the list of items, but don't do that if you don't need to. So notice that all of these are classified in the category where they belong. All right, so now we have your currency. We have your monthly cost to company. So the way we're estimating that, notice that this number is black. So the number being black means that it's a formula and you shouldn't change it. You should change the blue numbers and those affect the black numbers. So in here you have annual salary, and that's the one that's affecting your black numbers here. So say the CTO, these are placeholders, but say, you're going to hire a top tier CTO and that guy or girl is going to make, I don't know, $150,000 a year. So that's the salary that you offer. We're offering them $150,000 a year. And then there's a number here for the payroll, taxes, or other benefits. So if you're doing insurance or if you're doing, just the payroll cost, there's a cost on top of what you offer the employee. So you can play around with that number, say it's 15%, and that's going to change on the monthly cost to company. So there's a salary. This is the salary that you tell them you're offering, and this is the monthly cost to company. That's what the employee is going to cost you. That number is the same if you don't have any overhead payroll costs, so you can do that 0. Then we have the first hire. So when does this employee join the company? And then normally you'd have to go into a sheet and kind of estimate, or add these numbers, which really gets cumbersome. And you're going to see this reflected in a second. But you can go ahead and say, well, I'm going to start with the CTO in January 2021. And then there's going to be a VP of product, but I'm not going to need that guy yet. I'm going to wait, and I'm going to need that, that guy hired 1 year later. Say senior developers. So I'm going to need senior developers as soon as I hire a CTO, maybe 2 months later. I'm going to start with the first one. So that's March. And I'm going to hire 2 senior developers every quarter, all the way up to 10. And then there's the annual increase. So there's the salary increase if you want to do adjustments, or if you don't, so you can set that to 0, let's say. So here we have, I don't know, maybe their salary is going to be 100 a year. So this is going to be estimated automatically, and it's pretty beautiful. I'm going to go into the detail of the SG&A sheet later, but just to show you what that did is we have here your headcount, and you have your senior developers. So as you can see, we've added 2, and then next quarter we add 2 more, and then next quarter we add 2 more, and so on and so forth, all the way to 10, which is our maximum. So in the course of a year and some, you're moving from 2 to 10 developers, but that gets calculated automatically. So all of that is controlled from here, and we feel that this is a much easier way to do it than having to go and kind of scroll through these, in a month-to-month basis and kind of understanding where each one of these get hired. You can do it, of course. So if you don't like our teams and salaries section and you want to do it manually, you can, absolutely. So instead of doing 2 here, you want to say, well, I want to do 3 this month, and I want to forget the formula. So make sure that you just keep this in order, make that number blue so you know that it is an input and not a formula. But yeah, you can totally come in here into the SG&A and to headcount and just add those numbers manually. But at least in the early stages, as you're estimating the size of your team and the scale, doing it through here is probably easier and easier to manage and control. You can, of course, also hide these others. So if you don't need them, sorry about that. Let's hide these. So if you don't need the others, you can just select them and hide them. And that way they won't bother you. But that's that for the team. So the team is really important in the model. If you're using this model to build a pitch deck or to kind of estimate your company expenses, making sure that the stuff in here really matches your growth projection. So if you want to, if you expect to launch the product in 6 months, well, how big of a team do you need to develop and launch a product in 6 months? So make sure that those numbers reflect that. And also timelines, right? So, you're probably, if you're building a product, you're hiring your first product team, you're probably going to have to hire them in X month and then only launch the product until 6 months later or something like that. All right, so next up is the projection sheet. So this sheet is empty in this model because this is the kind of the free sample template. The idea is for you to come in here and build formulas yourself. So you're going to say, you can add different variables here. So an example, I'm just going to do a quick example of how that would look. Let's say I want to do, monthly revenue. And I'm just going to copy the format from here. I'm going to say, 1,000. And then I'm going to say monthly revenue growth. And that's going to be, let's not use a number. Let's use a percentage, and it's going to grow at 10%. So this is not a great way to run a model. By just saying that your revenue is going to grow 10% month over month is just unrealistic, because what drives that revenue growth? There should be a marketing campaign or a sales campaign that kind of boosts that revenue and makes it grow month over month. But the point is that all these variables you want to keep in here. So this is going to be your main input sheet. So all the variables, all the stuff that you want to control as to how your business scales, you should add those variables here. And by adding them here, you keep them in one place, and then you can go to the respective sheet, in this case revenue, and connect them and say, well, this is the revenue source 1, which we're calling sample. And I'm going to come in here and connect and say, well, our revenue is going to grow. I added $1,000, so I'm just going to grab the number from here, 1,000. And then I'm just going to multiply that by the growth, which is this. And there we go. Oh, sorry. It's times 1 plus that. There you go. So that's 10% growth. And you can potentially extend that formula all over. Let's see, projections. There you go. Just extend it, and then your revenue is going to scale 10% month over month. Again, that's not necessarily realistic, but it's a quick way to connect your revenue sources. And you could say, well, what happens if I grow by 20%? Then those numbers automatically change. So this projection sheet becomes kind of like a control center for everything that happens in your model. Now, I don't want to go into details as to how to build different models here, because that's just complex. We have some videos about them. I've did a webinar on how to build a SaaS model, and we build it all the way from scratch. But most importantly, most useful, we've built those templates already. So for an ad-based business, for an e-commerce business, we've added all these variables in here, and you can just buy that model and use them, or maybe you already have. All right. Okay, so next up is the charts and KPIs sheet. Now, this is a great sheet because it's a summary of everything that you're doing. So right now, based on these little changes that we made, notice that we still don't have any revenue. We only have expenses. We have this team that we created. Remember, we created a senior developers team over here, and that team is growing by 2 people all the way to 10. So since that team is growing, your expenses are growing, and we're still not generating any revenue, or at least we haven't added it to the model. So this just looks like negative numbers as that team scales. Your cash in the bank, assuming it starts from 0, your initial cash balance, that just goes negative and never grows. That's okay. We haven't added revenue yet. But this is kind of like the summary of everything, right? Normally, when I'm working on this, I look at projections, I make the projections that I want to make here, and then I go to charts and KPI and see what those projections look like. If the business is going to a profit, or when do you need to raise money? And then the use of funds, which is great. This is the stuff that I told you about here on the teams and salaries sheet. Whatever you classify this, for example, if you classify these senior developers as operations, then that's going to automatically change here, and then your operation is going to be your biggest expense. So it's a good summary of where your money is going. This is only taking into account the first 18 months into the model, by the way. And then capital required, well, what this is doing is it's saying, well, in order to support this business for the whole period of time here, you're going to need $10 million, and this business is not reaching profitability. Again, let me do a very nasty example, but let's say that you're going to start making, I don't know, $1 million a month, no, maybe less, $100,000 a month. And that's going to grow by 15%. Again, don't do it like this, because this is just a sample, just to show you how this gets reflected. So we have the sample here, sample model. We're saying that the first month we're going to make 100,000, and then that's going to grow by 1 plus projections, 15%. Great. There you go, 115. So let's lock this number. Let's do the summary of all the revenue here. There we go. And we can just copy and extend this all over. There we go. So that's just going to come up with a random crazy number. But what I wanted to show you is how this business just scales crazy. Since it's growing so fast, you never need money. So let's maybe make something less of a bold projection. Let's start at 10,000. There we go. So this is more closer to a classic startup story where in the first few months you are cash flow negative, so you need some money first until your kind of sales and your growth kicks in, and after that you become profitable, so you don't need more money. So this capital required here is this gap here in your cash in the bank. So wherever that's 0, we're estimating what this number is, and that's the number here. So that's potentially the amount of money that you would need to raise, around $600,000. So normally investors want to see this. They want to see what your expenses look like. They want to see what your growth and revenue curve looks like, and estimate, what the amount of money needed to kind of cover that gap. Some businesses are not profitable this fast. Again, this is just a random, very non-educated sample of a business. So it's not necessarily bad if you're not profitable right away, or within your time period. Just know that if you're raising money, if you're only funding part of this curve, you're gonna need to raise money again in X amount of months. All right, so let's delete this and be done. All right. So I'm going to do the financial statement month first. So this is just a summary of everything that's happening on the sheet. I'm actually going to do this last. Let me skip this. Let's go to revenue. We talked about revenue already. Revenue lets you estimate different sources of revenue. So we've added four different blocks. What I would recommend here is to use one block per business model. So if you're doing a subscription, for example, any subscriber coming to your business should be a single block, and you should use an average of your different subscriptions to estimate scale. But for example, if you're doing subscriptions and at the same time you're doing some consulting, then yes, that consulting part should be another revenue block. Again, try to keep it to as fewer blocks as possible. Even if you have, 5 different plans in your platform, instead of using one block per plan, kind of merge them all into one. You can use an average of the MRR or the revenue per plan to estimate this. All right. Cost of goods sold, what that does is it lets you estimate the direct costs to providing your service. On a SaaS company, those costs are a software company, those costs are probably going to be Amazon Web Services, Intercom for support, MailChimp, the tools that you need for your product or your business to operate. In an e-commerce platform, the COGS sheet is much more complex because when you're in e-commerce, you're buying products, you're buying goods, and then you're reselling them. So purchasing those goods, those numbers go here. So the margins, the COGS sheet lets you estimate the gross margin for the company. In a SaaS product, that's probably going to be 90%, so in any software really, 90%, 80%, because the server costs to provide that service are very small. On an e-commerce platform or even, a supermarket, those margins get a lot smaller, probably 20, 30%. It really varies. Of course, it needs to be a positive number, otherwise you'll be losing money. But that's just a margin on the services. So we have a few categories, like preset categories that you can totally change. We have web services. This one's empty. And then we have payment processing. So for example, if you're using Stripe to charge people on your credit card, there's a 2.9% fee for any charge for any revenue. So you can literally take your total revenue and multiply it by 2.9% to estimate the cost of actually processing those payments, assuming that you're going to be doing that with credit cards. But that's what COGS does. Notice that all the numbers here are blue except for the summary. So these are really for you to come in and change. You can do AWS and say, well, I'm going to be paying, $40 a month for AWS, and then Intercom for support. Maybe that's 150. And right now the formula just gets extended forever. Know that it's not going to be extended forever that easily. So probably as your number of users scales, that number is going to scale. But that's just very different company to company. So right now we just added blue for everything, and you can come in here and estimate for your own business. All right, so where most of the work is going to happen is in the SG&A sheet. So this is the sheet that's going to estimate, it's called Sales, General, and Administrative Expenses. So pretty much any marketing costs, sales, your business, your operations, your office, all of that stuff is going to go here. It's this sheet where most of the work goes and most of the expenses are logged. So this sheet has a payroll section, marketing growth, advisory and professional services, rent, tech support and services, insurance, utilities, and other. So payroll, notice that the numbers on payroll are all black. Why? That's because we're estimating those numbers on the teams and salaries sheet. So this sheet is connected to this section, and that way you don't have to go to each one of these and estimate them. So notice that the expense category is just being replicated from the other one. And we have two sections on payroll. We have the actual payroll costs, which is the salaries and the salary raises for everybody. And we have the headcount. So these numbers here as to how many people we have, those are just being pulled from the other sheet. So remember, these are the senior developers that we estimated. They scale from 2 to 8. We have one CTO forever, and so on. So you don't want to come in here and change these numbers. Probably better if you work from the team and salary section. But for the other ones, yes, notice that these are blue, so you want to be working with them. So you want to be using your marketing and growth to estimate, MailChimp or HubSpot or whatever tools you're going to be using. So these are the tools that the marketing team uses. We've created a few sections for campaigns, but you can change them. So you can make this, digital ads, and you can make this offline ads if you want. So anything that's blue, you can change. So I don't know if you want to do billboards or anything like that. Experiment campaigns as well. So anything that's blue, you can change, and then you can just come in here and add the numbers, and that gets estimated automatically. Ideally, you want to connect these numbers to growth. So, out of X amount of revenue spent on, X amount of ad budget spent on this group. What's the acquisition cost? I don't know, 100. So maybe that's 15 customers. So you can go to the revenue sheet and connect this expense to your cost of acquisition, and then estimate how many customers you're getting. Like I said, we've built models that already do this, but this is the blank canvas that you can customize any way you want. All right, so we have advisory and professional services. I added 2 sections for the recurring versus the one-time. So I don't know if you want to do an accounting firm that's going to handle your books, maybe that's, I don't know, $1,000 a month. That's just forever. But if you want to do one legal expense, which is incorporation, you can do it once and then you don't need to spend it again. Usually, we don't need to keep a law firm on retainer, so there's no need to play a lot with this. But I see a lot of companies kind of outsourcing part of their development, which I think you never should do. There's a video on that. But yeah, you can add it here and say, well, we're going to outsource the app development, and that's going to be $150K. That's a one-time expense, and you can add it whenever you need to. Okay. So notice, again, these are blue, up for change. We have rent, and then the office. This is cool. Notice that the projections does have this. So we're saying that what's the cost of having a desk? This is based on like a ballpark WeWork estimate, let's say 350. So what we're doing here very easily is taking your headcount that's coming from your teams and salaries estimation, 248, and then we're multiplying that by 350. So that gives you the cost of an office, assuming that it's 350 per seat. Again, assuming this is a co-working space of some sort. Otherwise, you can come in and change it, right? And then actually, by my rules, and this is a bug that I have to fix now, this number should be black. And let's just do that so we keep it correct. So that's black because it's a formula. It's a result of something else. Okay, tech support and services. This is a section I use for like general tools that the team needs for their day-to-day. I'm talking Slidebean, for example. I'm talking Gmail, whatever day-to-day tools, project management stuff. Insurance. So if you're not estimating your insurance as part of your teams and salaries here, the overhead, the taxes and benefits, maybe you can do it here if you want to do it like a percentage of the employee. But if not, you can just do it here and say, well, maybe I'm getting, I don't think so, but maybe you have a flat cost of employment insurance. Maybe that's, 400, and then you can just multiply that by your headcount, and that should give you the right estimate. And then, of course, stretch the formula all the way. Right, so, and that should be black because it's a formula. Assets, we pay some company insurance like errors and emissions and that sort of thing, so you can add those there. Utilities, if you want to go that deep into calculating your power and your internet costs, it's probably not going to be too much. It's probably not going to affect your model too much, but or your profitability, but it's there if you want to estimate it. Eventually, that cost is going to come. And then finally, others. So I usually keep travel, meals, bank fees, and all the other stuff here. These are all blue, again, up for you to change and modify as you want. So normally what we do with this model, we use this. This is a tool that we use pretty much every week, twice a week, and probably working on this sheet. Why? Because we connect all of these expenses to reality. So for example, if we're buying a new, if we're expect to be hiring 3 new salespeople in the next few months, that number of sales, the size of the sales team is connected, for example, to the HubSpot costs. So we know that the HubSpot cost is going to increase as we increase our team. Or for example, our mailing system, our email sending system, which is Intercom, is connected to the number of customers, the number of people that's active on the platform. So we know that if we estimate that the company is going to scale this much over the next few months, that means that Intercom or any other costs that are associated with operating the business, that's going to scale as well. And that's the magic of a model, that it's alive, it's fed by the real data that you're collecting as you evolve in the business, but also gives you pretty accurate projections of what's going to happen later. In the end, balancing that profitability is the core of our job as CEOs. All right, so the last sheet in a standard model is this one, which is the CAPEX and working capital. As I mentioned, there's the account receivable stuff, which I'm not really going to touch on. But most importantly here, what we have is the capital expenditure. So if you remember from the settings sheet, there's a setting that will let you automatically estimate new computer purchases for new employees. You can say yes. That means that that whenever new people are hired, you're going to have to buy computers for them, and that's just happening automatically. So that's happening here. If you remember, we set it as two new developers every quarter, and as you hire those people in here, their new computers are automatically added and estimated. So again, these are not expenses. These are assets that the company has. You can't necessarily write them off in your taxes right away. But what you can write off is here, your depreciation. So those computers, those assets that you have are depreciating over time. And that depreciation, that is something that you can write off. And that gets accumulated automatically. Even actually when computers completely depreciate, so when their value reaches 0, the model automatically estimates a new purchase, assuming that that computer died, or it's of course an average of all the assets. So again, these are the sheets that a normal financial model has. Most of the work usually happens in revenue, COGS, and SG&A. Just to keep that sorted and organized, you want to do most of the variables and projections, so you don't have to be jumping between sheets to kind of control them. Last but not least, I want to talk about the financial statement sheets. So these are pretty much a summary of everything that we've just talked about. They range from revenue to cost of goods sold and SG&A. So these are all classified in your income statement. And this is going to be combined with your balance sheet. So the balance sheet, like I said, expenses that are logged in the working capital sheet and the CAPEX sheet work a little differently. They're not expenses, they're assets. So they're part of your balance sheet technically. So if you own cars, they're part of your books, which is very different from expenses in software, for example. So that's why they belong in different categories. And that gives you a final cash flow, which is the actual cash in hand that the company has. Right now it's all negative because we haven't enabled any revenue. We haven't programmed any revenue in here. And that initial cash balance, which started at 0, is going down as your expenses kind of piled up month for month. So technically, the number that you potentially want to raise is the lowest number here. So for example, if you want to raise capital for 18 months of runway, you're going to be looking for the lowest ending cash balance number here, which is $1.4 million. Again, this is a company that generates no revenue, but this company costs this much to operate. If there's revenue here, if you've enabled any revenue in this company, in this model, let's see if we still have that. Yep. So if we've enabled revenue in the company, then that number is going to change, of course. If we go to financial statement month, you can see that there's a negative cash flow as revenue takes some time to scale, but as that revenue scales, suddenly this number becomes positive. So the number that you need to raise that you're looking for is the smallest number here in this line, which we're estimating automatically here in total capital requirements. And that's the number that we're giving you here in charts and KPI. So right now we're reporting 18 months to reach profitability, and that's all visible here because your cash flow becomes positive on month, month 18? Here, there you go. Ending cash balance, month 19. All right, so compared to that, we have the financial statement annual, which is pretty much the same thing, except on an annualized basis. One thing to look at here is the gross margin. So remember, gross margin is the comparison between the revenue and the cost of goods sold. Right now, we haven't had anything, so it's 100%. Like I said, for a SaaS business, this is probably going to be in the 80-90% range. For an e-commerce, maybe it's going to be in the 30% range. SG&A, that just comes after that gross margin, and then balance sheet again for the annual. The other number that I want to point your attention to here is this net present value. So that's the valuation that we talked about earlier on the settings. So if your valuation is a multiplier of your EBITDA, in this case, let's just make it 1, because otherwise this number is just becoming astronomically big because of it's still pretty big. Let's keep revenue growth smaller. All right, 10%. All right, so if you go to statement annual, so this is the net present value, as you can see, and that's based on the revenue that the company is generating and this discounted cash flow formula that I mentioned earlier on, and the exit value that we're assuming as a multiplier of your EBITDA. Now, we've added 2 bonus sheets in this model, which are the funding equity calculators, which are pretty slick, pretty self-explanatory. So we have 2 approaches, which are the equity and the convertible note. So for equity, assuming this is a first investor that's coming in, they're getting stocked. It's not a convertible note. They're getting stocked right away. So the inputs here are how many shares of stock have been issued. Normally, companies should be incorporated with 1 million or 10 million. So this is a standard. Then how many shares do each one of these founders have? Maybe you guys are doing, 40, 40, 20, something like that. So that means that you have 4 million shares of stock based on this 10 million number here. Then you're saying, well, how much money are you looking to raise? Maybe that's 500,000. This number is not connected to the rest of the sheet, by the way. This is just a quick calculator to let you estimate like how shares would look. So let's say it's 750, and then you're raising on a $5 million pre-money valuation. That means that the post-money valuation is $5,750,000. That means that the company will need to issue 1.5 million new shares of stock to the investors, and it'll have now a total of 11 million shares of stock, and the investors are going to get 13% of that. So notice, common misconception is that shares change hands, which is not the case. Shares rarely change hands, and it's actually a big legal and tax mess to sell shares. What's usually done in fundraising is that the company issues new shares. So in this case, notice that the number of shares that each one of the founders had at the beginning has remained the same. The difference is we've now added or issued 1.5 million new shares. So the total number of shares in the business is 11 million. So founder one still has 4 million shares. It's just a smaller percentage because now the company has issued more shares in total. And there's a nice chart if you want to visualize it. With convertible notes, it's rather simple. Remember that a convertible note is kind of bridge funding that doesn't have a valuation. It's kind of waiting for a new round of funding to answer the question of how much the business is worth. There's a whole video we made on how convertible notes work, so you can go and check that out if you want. But let's do the same math. We have 10 million shares at the beginning, founders with 40-40-20 share distribution. How much money are you looking to raise in this convertible note? Let's say it's $500K for the convertible note. What are the terms? So there's going to be a discount on the future valuation. There's going to be an interest rate. If you're doing a save, then the interest rate is 0. And there's a cap on the maximum valuation at which this note will convert. Again, details on the video I mentioned. And then you're going to need to, so this is going to be temporary, but what you expect is that you're going to use this bridge funding to raise a Series A. So let's assume that Series A is at a 10 million valuation, that it happens 18 months after the original note. That's in case there are interests. So I'm going to add that back here just to demonstrate. And then the investment size in the new Series A round is 2 million. So what's going to happen is the convertible note will convert first with these terms. So there's some accrued interest from the 18 months that passed. There is the applicable valuation. So in this case, it's the cap, 6 million. If the cap were larger, then the applicable valuation would be not the cap, but the valuation of the Series A minus the discount. And then the shares issued to the convertible note investors, total shares after the convertible note converts, that means the convertible note investors get 8.22%. And then, they get 8.22% now, but then there's the Series A converting. So the Series A comes in, that's an extra, $2 million in capital. There's a post-money valuation, total company stock of their Series A, percentage owned, and then this is the new distribution, right? So convertible note investors get this, Series A get this, and then here's the distribution. Again, notice that the number of shares has not changed. The only thing we've changed is the total number of shares in the company and how that distribution gets affected. So again, these are mostly to provide a little bit of an exercise to understand what your share distribution could look like in the future. All right, so that's that. Like I said, we've sort of built this template and made it available for free. We know for a fact that at least 10,000 people have downloaded it, and we know that there are a few investors and firms recommending our model as a template. So we figured that we should make a proper video on how the financial model works. Most of this stuff you can build in some very basic spreadsheet Excel skills. Like I said, if you don't want to kind of build your own model from scratch, we have a model for a SaaS company subscription business. We have a model for a marketplace business where you connect buyers and sellers, a model for an e-commerce platform, and a model for an ad-based business, which pretty much summarize most of the companies out there. So those are pre-built. All the variables and all the projections are already built in there. For example, you can take a look at this one, which is the subscription model where we automatically let you estimate, for example, the revenue coming from self-service subscriptions, assuming your customers come in and subscribe on their own, or the outbound sales model in which you have sales agents or sales development reps that are doing outbound calls or outbound reach out to customers. So all of those formulas have been built, and you can enable and disable the models here. Again, all the projections are there, and they're connected to the revenue sheet to kind of estimate how your business scales in the future. So it's really like a white canvas where you can come in and add your your other stuff, your actual pricing, your scale size, your market size, the size of your team, and so on, and estimate how that business is going to perform without having to kind of build a spreadsheet from scratch. So if you've purchased any of those models, this is going to be part 1 of that tutorial. There's definitely going to be a second part that you're going to be able to see on your model itself, where you can access the details as to how that model specifically works. But again, this template that I just used today is available for free. I'm going to link that in the description. So I hope you find it useful. Best of luck with your financial modeling and best of luck with your business. We'll see you next week.